Every spring, millions of us sit down at a kitchen table, sift through a pile of W-2s, and treat tax season like a data entry chore. We check the required boxes, copy the numbers from one form to another, and assume our financial lives are too straightforward to mess up. This casual mindset costs millions of ordinary taxpayers' money every year through voluntary overpayments and avoidable penalties. The root of these financial losses rarely comes from complex offshore accounts. It happens because taxpayers look at specific, distinct legal mechanisms in the tax code and treat them as if they mean the exact same thing. Keeping your money doesn't require a high-priced accountant or uncovering secret strategies designed only for the rich. It just requires abandoning the idea that taxes are simple and taking the time to understand the crucial mathematical differences between the terms you're checking off on your forms. Let's start with what is likely the single most expensive mistake on the standard return, using the terms tax deduction and tax credit as if they are interchangeable. This chart illustrates the difference. A tax deduction only shrinks the initial pool of income that the government is legally allowed to tax. If you make $50,000 and claim a $1,000 deduction, you simply pay your normal tax rate on $49,000 instead. Now, looking at the final tax bill, a tax credit operates completely differently. A credit is a dollar-for-dollar reduction applied directly to the final amount you owe. A $1,000 credit wipes out exactly $1,000 of your tax debt. Eligible taxpayers routinely miss credits related to their children, higher education expenses, or clean energy improvements. By mistakenly thinking these are just minor deductions that barely affect their bottom line, they leave thousands of dollars unclaimed. A deduction lowers the amount of money you are taxed on, but a tax credit essentially pays the tax bill for you. Understanding that difference is worth real, tangible cash. Another area where casual definitions cost people money is filing status. Many taxpayers select single or head of household based on how they naturally describe their living situation to a friend. The IRS does not view these as demographic labels. They are strict mathematical brackets that permanently lock in the size of your standard deduction and dictate exactly which credits you are allowed to claim. This casual approach is even more dangerous when it comes to side income. Whether driving for a rideshare app, selling goods online, or doing freelance work, it is easy to assume that because taxes weren't automatically withheld from your pay, that money flies under the radar. This flowchart breaks down the automated background matching system the IRS uses. When a gig economy company generates a tax form, they send that data simultaneously to you and directly to the government. The government already knows what you earned. If the numbers on your final tax return don't perfectly match the data already sitting in their database, the system automatically triggers flags that can delay your return or lead to a review. The IRS doesn't care about a taxpayer's personal definition of a side gig. They only care if the submitted return mathematically aligns with the data in their institutional records. That strict adherence to records cuts both ways. Freelancers and small business owners routinely overpay their taxes because they fail to claim legitimate business expenses, like office supplies, mileage, and software subscriptions. As this 1959 Schedule D form shows, the tax code has structurally required rigorous itemization for decades. You can't just guess your expenses. You have to maintain meticulous, organized documentation and receipts to prove them. Contrast that historical reality with how people get tax advice today. Every spring, social media feeds are flooded with viral videos from creators claiming they've discovered secret legal loopholes and hidden tricks the government doesn't want you to know. Replacing hard math and accurate documentation with oversimplified viral advice leads directly to denied deductions, added interest, and the high probability of an audit. The tax code is already packed with perfectly legal strategies. You don't need secret tricks hidden on the internet. You need organized records and a precise understanding of the rules. All of this brings us to one final behavioral distinction: the difference between rushing to meet a deadline and preparing a strategy early. When frantically trying to finish your paperwork in one stressful evening, mistakes become highly probable. Rushing is the direct cause of the mismatched income forms, typos, and overlooked deductions that cost people so much money. The tax code functions as a comprehensive rulebook containing thousands of legal strategies specifically designed to let taxpayers keep more of what they earn. So start early. Evaluate the best filing status for your specific situation. Track your receipts, calculate the actual math behind your available credits, and tune out the misleading advice on your feeds. Paying taxes is a legal requirement, but by mastering the crucial distinctions within the code, overpaying them becomes completely optional.